To summarize, legends, tomorrow we have the Michigan Consumer Sentiment Index at 10 a.m. Watch the market reaction at 10 a.m. It usually is the opposite of what the market actually wants to do. So if the market rallies ahead of the report, then it will likely sell off on the report and vice versa. That's number one. Number two, watch on the 1 hour chart this resistance line at 451. If we get a break and a close above, we will likely continue in the next handful trading sessions to fill the gap of 456. If we reject, we will move back down to fill the gap at 446. The market is rotating into inflationary sectors, basic materials, real estate, energy, and utilities. In fact, a lot of these sectors are actually breaking out. Take a look at utilities. Breakout higher high versus this high in late August. If I add the S&P, look at this, it's outperforming the S&P. That's usually not a good sign when utilities are outperforming the S&P. Made a higher high versus the S&P 500. Same exact look on XLP, legends. XLP right here made a double bottom with a positive divergence on the PPO. The RSI is getting close to crossing the 50 reading, and it is now at the lower edge of this consolidation, this range-bound market. A breakout in consumer staples, utilities, energy, real estate. All of these sectors tend to rally when inflation expectations are rising. In addition, we have a breakout in the breadth, significant breakout, huge breakout, and we do have a double bottom with a positive divergence. The CPC put to call ratio is at a top. That usually means, legends, that the market will want to continue to grind higher despite the seasonally weak time of the year. And based on seasonality, legends, we expect the market to continue to grind higher into September 20th. That means 3 additional trading sessions where we could see the market continue to rally. Usually, legends, September 20th onwards, that's the 13th trading day in September. Usually we get a sell-off, and once that is done, we usually get another bounce in early October. Welcome back, you legends. I'm Dr. Cal, and I want to start out with an apology because this video is going to be late, and that's because I recorded the entire video and then I found out the audio was no good. It was cutting off. Turns out, legends, I plugged the microphone in a high power USB port, and that just screwed with it. Plugged it in a different port. So far, so good. So let's get right into it, legends. This is the stock market map, green all over the place, but that does not tell us the story today. Let's look at the different sectors. That tells a completely different story. Look at this. Leading today are materials, followed by real estate, energy, and utilities. It's not tech, it's not cyclicals, it's not growth. It's the inflationary sectors. What do all of these 4 sectors have in common? They're all hedges against inflation. Materials, a hedge against inflation. Real estate, a hedge against inflation. Energy prices, a hedge against inflation. Utilities, all hedges against inflation. When inflation is rising, utility bills go up, energy costs go up. Real estate, renting, anything goes up. The cost for the bill of materials always goes up. So why was that reaction today? Well, we had the PPI today, legends. And just like yesterday, the core number was in line with expectations, but the headline number was significantly above expectations. We're looking at 1.6% versus 1.2%. That's 30% above expectations. 1.6 divided by 1.2 is 30% above expectations. That's a big differential. And we're seeing that directly in the stock market. We're getting that inflation trade back on. We're seeing rotation out of high-flying tech names. Look at this technology, second to last today, with all of these inflation sectors rising. Let's take a look at the different indices. Dow Jones 0.96%, NASDAQ 0.8%, S&P 0.8%. What does that mean? Well, the Dow Jones outperforms the S&P and the NASDAQ quite often when things are bad. Well, why is that? Because the NASDAQ is filled with these high-flying tech names, growth names. The Dow Jones is more value-oriented. Where do you want to be when inflation is rising? You want to be out of growth because growth is very interest rate sensitive, and you want to be in value. That's why we're seeing the Dow Jones beating the NASDAQ and the S&P. Now let's take a look at the daily chart for the S&P 500. We're still squashed between a support and a resistance of what looks like a symmetrical triangle, the head of a bull flag. This is the bull flag. This is the pole for the flag. This is the flag itself, the pennant. And we're still square in between resistance and support. We had a rally today. We broke above the 5-day and the 9-day moving averages. This orange and light blue line is the 9-day. This green line, this rising green line, is the 5-day moving average. We had a breakout today on strong volume, but it was led by those inflationary names. That should tell us that the NASDAQ is relatively weaker, and it is. The volume, yes, it's up, but it's still below average. Dow Jones led the show today, almost back to the August 31st high. S&P not there yet. NASDAQ not quite there yet. What about the Russell 2000? Apologies, legends. These are annotations from the video that I just recorded with the bad audio. So let's clean this up. The Russell looks very nice. I have to say, very nice. Look at this double bottom, higher low on the PPO, higher low on the daily chart. It's a lower low if we take a look at closing prices. Let me exchange that with lines. Look at this on a closing basis. This is a lower low. So this is a bullish divergence because we had a lower low on a closing basis and a higher low on the PPO. So I definitely like that. I love that. I love double bottoms with positive divergences. They are my absolute favorite reversal setups. And we're getting a breakout today. This is the first close above the 20-day moving average, this dark red line. Why does it matter? Well, we don't get breakouts above the 20 often. Often when we do get one, we get big moves, right? Here, break above, big move, break above, big move, break above, big move. In this example, we broke above, but we did not get a big move because we had to get a big move just to break above it. In this example, the 20-day moving average is much, much closer to our actual consolidation pattern here. So just a small candle today was enough to break it. And that opens the door for a rally to the 50-day moving average all the way to 189 and these prior swing highs. So I do like the Russell. It's probably one of my favorite setups right now. The Russell, I favor that over the S&P and the Dow Jones and the NASDAQ. A lot of tech companies have already rallied a lot. Unlike the small caps, the Russell 2000 still has a lot of meat left on the bone. Let me add the triple Qs, the NASDAQ 100 to showcase the difference here, legends. So this is the NASDAQ 100 down here. This is the Russell 2000. Look at the difference. Look at the massive difference. Equal highs on the Russell, massively higher high on the NASDAQ 100. The Russell, in fact, is still way, way, way off the all-time highs, 32% below the all-time highs, while the NASDAQ 100 is much, much closer to those all-time highs. 7%, that's all that separates the NASDAQ from the all-time high, just 7%, while the Russell is 32% away. That means there's a lot of upside potential in the Russell relative to the NASDAQ 100. And one other way to actually quantify that is to look at the Russell relative to the NASDAQ. And we have this chart. This chart is the Russell 2000 relative to the NASDAQ 100. The PPO is still struggling, right? But we are forming a higher low on the PPO while the price action is forming a lower low. This is a positive divergence. We had a break, the first break above the 50-day moving average back in July. We need to get another break. If we get another nice break, I think we get a neckline, and that neckline sets us up for another rally attempt higher where the Russell should outperform the NASDAQ 100 and the S&P. Overall, legends, looking at the historical performance of small caps relative to the NASDAQ tends to absolutely kill the small caps, with the exception of the 2000 internet bubble. Otherwise, the small caps have been consistently underperforming the NASDAQ 100. But keep in mind, legends, even just a relative performance that's 10% greater. So if the NASDAQ rallies by 10% and the Russell is relatively 10% stronger, we're looking at 20%, a 20% rally. So that's still significant. I'm looking at a reconnect with these prior swing lows. Let me highlight them right here. I'm looking at the Russell rallying back to these levels, these levels, these levels. What does that look like? Well, relatively speaking, that looks like about 13% relative to the NASDAQ. So if the NASDAQ goes back to the all-time highs, we're looking at the Russell hitting a 20% rally. So what about timing the entry? Well, in this example, because this structure has been forming for quite a long time, I'm referring to this double bottom structure. It's been forming for a long, long time. I would have to wait for the PPO to produce a bullish cross. That means a green candle on the histogram. Not there yet, but we could get there pretty soon. I think by the end of October, we'll probably see the small caps really, really rip to the upside. The NASDAQ was the best performing out of all the indices in the summer. So it already rallied big time, as I showed you just earlier. The Russell is still just moving sideways. It is trying to grind its way out of this slump, and I think that's going to happen very likely in October. So I'm looking at late October for the Russell 2000 to begin to break to the upside. Now, in the medium term, I do like the fact that this 200-day moving average has flattened and it's been rising recently. Price has held at the 200-day moving average several times. So bulls are defending this moving average. So I would not mind an entry here, but the way I would personally trade a breakout in the small caps is to trade individual small caps names. The Russell 2000 is absolutely chock full of garbage stocks, garbage companies, zombie companies. I would not buy the Russell in its entirety. I would actually look at the best small caps and buy those. I have some in mind. I shared those in the trading community. I think a lot of you already know about them. One of those key names is actually PayPal. And I did share a beautiful, absolutely gorgeous setup on PayPal in the trading community. Long PayPal, calls, shares, all of it. If you're interested in that specific setup, check out the trading setups in the Discord community. I shared the details with targets by the end of this year and going into next year. Obviously, it doesn't have to be PayPal. You can trade anything you like in the small caps. PayPal just happens to be one of those absolutely 1 in a 10-year setup. That's the kind of setup that I'm talking about. You only get one setup like this every 10 years or so. Again, all the details in the trading community if you're interested. Okay, so short term, what are we looking at on the S&P 500, the SPY? Well, we have this resistance line, very clear resistance line. It stopped the rally in early September, late August. It stopped the rally at the all-time highs in July. This is the resistance line of the pennant. We're about, let's see, very close to it, $1 away. The resistance is actually at 451.5, so slightly short of these prior highs at 453.5. This is going to be a key area, legends. The way the price reacts at this level is going to tell us a lot. If we get rejected, we will almost certainly go back down to test this support line. If we hold and actually break above, we will almost certainly go back to fill the gap at 456. Now on the daily chart, the PPO is positive, but it's very tight looking. And the RSI also positive above the 50 reading. So all in all, still in an uptrend, albeit an extremely choppy uptrend. Now there was a nice setup yesterday on the smaller time frames. We had this double bottom here. We also had a double bottom on the 10-minute chart that I shared with a full measured move at 449. So we ended up actually opening at the full measured move. Let me share the setup with you. I shared this at the market open yesterday, just after the market open. We formed this double bottom with a positive divergence. The full measured move on that structure was 449. Here's a closer look at it. Double bottom, 10-minute chart, higher low on the PPO, lower low on the 10-minute chart. Neckline breakout. That neckline breakout validated the double bottom and provided us with a full measured move of 449. How can we extrapolate these full measured moves? I'll teach you exactly how to do it. Here it is, legends. Look for double bottoms with a positive divergence. In this example here, it was very obvious. 10-minute chart, lower low on the 10-minute chart. It was established after this green candle broke out above the highs of the prior red candle. That established the double bottom. Here's the neckline. Very simple process, legends. We measured the distance from the double bottom to the neckline. You can do it from the higher low, from the lower low, whatever floats your boat. I usually like to do it from the higher low to generate a more conservative target so that we're more likely to get a successful trade. Now we put that distance up top. Here it is. It generates a target at 449. That's pretty much where we opened today. That's pretty much where we opened today at 449. We also filled the gap to start the day at 449.2. I was looking for this gap to get filled ahead of CPI. That did not happen. We got it after CPI. Also on the 10-minute chart, if you can guys see, we do have what looks like a bull flag here. Here it is. This is the bull flag. This was the breakout today. So that was a very cool little setup as well today. Breakout, sell off to start the day, come back down to the 10-period moving average on the 10-minute chart. Hold that support, continue to rally. We also ended up filling another key gap. That gap is at 450.5. It's more obvious on the daily chart. So let me pull that up. Here it is. We have a gap at 451.14. We filled that today, intraday. Now let's revisit the 10-minute chart very quickly. I do want to discuss this flag. Now this is an important structure. Why? Because it held at the 200 period moving average on the 10-minute chart. Then the 200 period began to curl back over. Now this could have easily broken to the downside on PPI today, but the way to trade this is to simply draw the flag. Just draw the flag, connect the highs, connect the lows. That's your flag. As soon as you break above the flag and hold, that's it. That confirms the breakout. It also generates a target. Let's take a look here. What does the target look like? Generates a target to 451.21. So we actually almost got there to that target today. That target also sits at this resistance line. So full measured move from the bull flag and this resistance line and the gap fill. A lot of things at this resistance line. Does the market have to stop here? Not necessarily. If it does, it's more bearish. I would say it is more bearish if it stops. If it continues to break out, and we get a close above this resistance line, a close above 451.5, we almost certainly continue to go up to fill the gap at 456.5 on the hourly chart. That's this gap right here. I also have it highlighted in the trading community. So this is important. What are the odds? Do we break above it? Do we not? Ahead of the Fed meeting, I think it's 50-50. Action here will determine that. So we'll just wait for that reaction. If we get a close, we can get a trade up to 456. Very tight stop loss just below the trend line, right up to the upside, close at the gap fill, and then wait for that Fed meeting. If we get rejected, then that's it. We likely go back down, maybe fill this gap, form another higher low, or maybe continue lower to 440. Still possible. I don't think we'll hit 440 until closer to the Fed meeting on September the 20th. That happens to be the 12th trading day in September. And what happens on the 12th trading day? Well, we usually get a top. We usually get a top in September at the 12th, between the 12th and the 13th trading days, and we get a sell-off after that. Significant sell-off. Takes out all the lows, all the prior lows in the month. Now, where is that 12th trading day? That 12th trading day is the 12th bar. That's September 20th. The 13th trading bar is September 21st. So purely based on seasonality, we're looking at a top next Wednesday to Thursday, and then a sell-off that takes out the September lows. Where are the September lows? Let's pull up the monthly chart. The September low sits at 442. 442.5. That's this low right here. That's in line with a choppy period consolidating within the pennant, right? Rally to the upside, either get rejected here or continue higher to fill the gap at 456. Then get rejected here. I think very likely we'll get rejected here, get a double top with a negative divergence. I think that's very likely if we get a breakout. Then get a sell-off and move back down to this support line, take out this prior high in line with the seasonality, taking out the prior highs in September. Taking out the prior lows in September. So in the very short term, we're looking at an additional upside to 451.5. If we manage to get a close above that, then that upside target gets upgraded to 456. So just watch the reaction here. And from that point, we are very likely to get another sell-off to end the month all the way down to take out these prior lows, so even lower. Probably to tag this support line. Let me extend it. There you go, legends. This is the same support line that's on the daily chart. It's the same exact one. Hourly chart, RSI above 50, stochastic inching closer to overbought. So we're getting close to overbought. We're getting close to overbought on both the RSI and the stochastic. So we're looking at maybe 1 to 2 additional days of upside. If those days are very strong, we'll get that gap held 456. If we get some trepidations in the market, then likely this gets rejected here and we move down. What's going to determine that? Well, we do have an event tomorrow, legend. Tomorrow, legends. That's the Michigan Consumer Sentiment, and it's at 10 a.m. Usually what happens, legends, when we get an event at 10 a.m. is we get either a gap up or a gap down to start the day. So we'll either open higher at resistance and then get a reaction at 10 a.m., more likely than not negative, or we get an open below, right? A gap down, open below, maybe at 449, then move sideways until 10 a.m., then rally into resistance and either reject or continue higher, one of the two. Quite often, legends, at the 10 a.m. marker, we get a reaction. Very often, legends, that reaction is the opposite of what happened in the previous 30 minutes. So, for example, the market opened lower and rallied, we usually get a sell-off. The market opened higher, then sold off, we usually get a recovery. It's usually the opposite. The market likes to play these games. It's usually the opposite. So watch 10 a.m. What's the market doing? Has it been rallying? Then watch for a rejection and a U-turn. If it's already been selling off, opened higher, sold off, then look for a rebound. Very often, legends, these 10 a.m. events produce a decision, a market directional decision within 30 minutes. So look at the reaction at 10 a.m., then look at the reaction at 10:30 a.m. We made a higher high. We likely set the trend for the remainder of the day. If we made a lower high or a lower low, then look for setting a downtrend for the remainder of the day. Hope that's helpful. Okay, let's talk about the VIX. I talked about the VIX recently. I was looking for this gap to get filled, the 13 gap to get filled. We got that gap filled. The market actually closed at 12.8 on the VIX. And on the 2-hour chart, we're likely now forming a double bottom with a positive divergence. Yes, we are. Look at this double bottom positive divergence. So expect either. So again, guys, expect either we gap up on the VIX, gap down on the S&P, and then see a continuation of the rally in the S&P, a continuation of the sell-off in the VIX, something like that, or the opposite, gap up on the S&P, then sell off. That means a gap down on the VIX and a rally in the VIX, because they're very strongly inversely correlated. One trick to follow, legends, just look up the VIX chart before the market open. It will have already made a move. If it gapped up, then look for the market to continue higher, for the VIX to move lower. If the VIX gapped lower, if it opened lower, then look for the VIX to recover and put pressure back on the market. Now, we've been discussing the VIX for a while. As soon as it broke below this bear flag, I discussed this. First, we got a rejection at the 50-day. Then we formed this bear flag, broke below it on CPI. I discussed this at length. As long as the VIX is trending down, the market will have a very difficult time finding sellers and shorts. Shorts will lose money as long as the VIX is declining. They don't like to short the market when the VIX is declining. Their favorite setup is something that looks like this, right? Double bottom, higher low on the PPO, and then they go short on this breakout in the VIX. That's usually what they do. They like these breakouts above the 20-day, including this bullish engulfing candle. This actually marked the top on the S&P. Here it is. That was the top on the S&P. It is extremely difficult to short the market, especially when it's in an uptrend, especially when the VIX is in a downtrend. Don't try to be a hero and short the market here looking for tops. That usually does not work out. Just look for signs of exhaustion in the market, tagging major resistance. Look for trend exhaustion in momentum, the stochastic, the RSI. All of these are important. Not there yet, legends. still more upside. And even after the exhaustion, I'd be looking more towards taking profit, not necessarily shorting the market, because again, we don't like to short an uptrending market. Higher lows, higher highs, okay? Let's discuss the Dow Jones. Dow theory model. Up top is the Dow Industrials. Down below is the Dow Transports. I discussed this divergent low in my, not the last video, the one before, and it actually called this bottom. It actually called the bottom. So it was a very cool setup. We had a double bottom here, higher low on the industrials, lower low on the transports. Usually, legends, divergent lows lead to a bottom. Divergent highs lead to a top, right? Divergent highs lead to a top. Divergent lows lead to a bottom. So far, so good. Still, I think some upside left, some meat left on the bone here. Again, either 451.5 at least, or above to fill the gap at 456. Either one. Now let's take a look at the smart money. I also discussed this. The smart money gave us a beautiful hint yesterday after the CPI, and I talked about this in the video. I came in later in the video, so if you watch till the end, you will not have missed it. That's why it's really important to watch the videos till the end, legends. And I discussed this bullish divergence. Look at this. This is the smart money made a higher high versus the high in September, while the S&P made a lower high, right? Lower high here, higher high here. This is a bullish divergence, and it led to the breakout today. So it hinted at the breakout today. Now look for the opposite to begin develop. Look for the high yield bonds, the smart money, to begin making lower highs as the S&P continues to make higher highs. That will likely establish a divergence just like this one that called this short-term top. These divergences, legends, usually last about 2 to 3 days. That's actually in line with the momentum. The momentum still has some upside left, maybe 1 to 2 trading sessions left. And as the market grinds higher, makes higher highs, look for the HYG, the smart money, to make lower highs. Often the third or fourth lower high is your tip, is your hint to get out, take profit. XLY divided by XLP, I discussed this at length, including in yesterday's video. Higher highs, higher lows. Whenever the consumer discretionary stocks are outperforming consumer staples, we get these breakouts. They coincide with significant uptrends in the S&P 500. We had a breakout on the market bottom. Look at this. Market bottomed August 18th. We had the breakout August 22nd. Perfect breakout, backtest, continued higher. So we're still making higher highs and higher lows today. We made a new 52-week high on this ratio chart. It tells us that we're likely going to continue to move higher. NASDAQ 100 relative to the S&P 500 up top. Down below is the S&P 500. And right here is the PPO for that relative performance. Look at this, legends. The NASDAQ is beginning to lose steam against the S&P. This is an early signal. However, look at this. You'll get the hint from the NASDAQ relative to the S&P well in advance of the market top. The market actually topped 1 month after this signal triggered a sell signal. In this example, again, look at this relative performance. Ticked down, but the market continued higher for a while still. In this example, it actually called the top perfectly. So it really depends whether the market is in an uptrend or a downtrend. When the market is in a downtrend, it usually calls the top perfectly, right? Calls the top perfectly. In an uptrend, it's early. So look for this to turn back down. Then look for negative divergences, something that looks like this. Higher high on the daily chart, lower high on the PPO that actually marked the top. So yes, NASDAQ losing steam against the S&P, but likely still some meat left on the bone. This is the S&P 500 relative to gold. I use this chart to mark the beginning of new uptrends. Whenever gold begins to underperform the S&P 500, we get these buy signals, and they've been right on the money so far. Whenever we got one, we got additional upside. We had one develop as we were pulling back, and we're still getting higher highs on the histogram. So again, legends, likely this is the beginning of a new uptrend. How long is it going to last? We don't know. It could simply be an uptrend that lasts for a short while, then fizzles out as we get into late September, which is seasonally bearish, and into late October, which is also seasonally bearish. But so far so good. As long as the S&P is outperforming gold, we do not like to open any short positions in the S&P 500. Let's take a look at the CPC buy and sell signal. The money time machine put to call ratio, triple top, and it cleared 1.1, came back down. These usually legends triggered by signals. We're now just waiting for the PPO to produce the buy signal. It hasn't done so yet. If it continues at this pace, we'll likely get a buy signal by the end of the month. And that would actually go in line with seasonality. Usually the market will bottom at the end of September, get a relief rally at the beginning of October, then continue lower. So if we get a buy signal at the beginning of September, that will allow us to catch that rally at the beginning of October, the first week of October, and then we'll take profit quickly. Wait for the second low. It is usually a lower low, a low that is below the August and September lows. So we're looking at a low that is actually below this August low, the 433 low. My guess is either a gap fill at 431 or slightly lower to 420. Either one of these by October, by the end of October. Let's look at stock market breadth. Remember this, legends, I talked about this in the last couple of videos. I discussed this in the last couple of videos. We got a huge breakout on breadth today. This is the S&P 500 200-day breadth. It measures the percent of stocks in the S&P 500 trading above their 200-day moving average, which is the gold standard breadth indicator. We got a big breakout today. So we expect, again, more upside, at least in the short term, then maybe consolidation into the Fed meeting and that seasonally bearish time, late September, then another big move by the beginning of October. But so far, legends, we got a double bottom with a positive divergence on the 200-day breadth. These usually produce very, very powerful buy signals. These double bottoms with a lower low usually produce amazing risk reward setups. Let's look at fear and greed. Continues to grind higher. Now, we made a higher low, right? We got that low in October, that low in March, that low in August. Each one is higher than the other. We're still in an uptrend. All of that continues to tell me that we will likely see a breakout and fill the gap of 456 within the next couple of weeks. The market continues to ignore higher than expected CPI and PPI. That tells me as long as the Fed accommodates the market, does not surprise it with a rate hike in September, the market will like that and might continue to grind higher. The question is, will the Fed hint at a rate hike in November? So far, legends, the market is pricing in only a 40% probability of a rate hike. It actually went lower today to 35%. So the market is discounting a rate hike. It is significantly discounting a rate hike. It's giving 2-to-1 odds of no hike in November. So if the Fed hints at a rate hike in November, the market will absolutely throw a fit and it will not like that. So to summarize, legends, tomorrow we have the Michigan Consumer Sentiment Index at 10 a.m. Watch the market reaction at 10 a.m. It usually is the opposite of what the market actually wants to do. So if the market rallies ahead of the report, then it will likely sell off on the report, and vice versa. If the market sells off ahead of the report, it will likely rally after the report. That's number one. Number two, watch on the 1 hour chart this resistance line at 451. If we get a break and a close above, we will likely continue in the next handful trading sessions to fill the gap of 456. If we reject, we will move back down to fill the gap at 446. The market is rotating into inflationary sectors, basic materials, real estate, energy, and utilities. In fact, a lot of these sectors are actually breaking out. Take a look at utilities. Breakout higher high versus this high in late August. If I add the S&P, look at this. It's outperforming the S&P. That's usually not a good sign when utilities are outperforming the S&P. And it's outperforming the S&P, made a higher high versus the S&P 500. Same exact look on XLP, legends. XLP right here made a double bottom with a positive divergence on the PPO. The RSI is getting close to crossing the 50 reading, and it is now at the lower edge of this consolidation, this range-bound market. A breakout in consumer staples, utilities, energy, real estate, all of these sectors tend to rally when inflation expectations are rising. In addition, we have a breakout in the breadth, significant breakout, huge breakout, the first close above the 10-day moving average since this prior breakout, and we do have a double bottom with a positive divergence. The CPC put to call ratio is at a top. That usually means, legends, that the market will want to continue to grind higher despite the seasonally weak time of the year. And based on seasonality, legends, we expect the market to continue to grind higher into September 20th. That means 3 additional trading sessions where we could see the market continue to rally, and then we'll reassess after the Fed meeting on September 20th. Usually, legends, September 20th onwards, that's the 13th trading day in September, usually we get a sell-off, and once that is done, we usually get another bounce in early October. If you enjoyed this video, legends, slap that like button right in the face. It helps me a lot. If you watched till the end and you did not enjoy the video, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.